A very bright Saturday morning to all of you, and welcome to the seminar on valuations, a most important subject of late. Any statute to deal with, there is valuation and the requirement to understand the valuation standards. So it's a pleasure to welcome all of you for this one-day seminar. I request our chairman to escort the first speaker of the session today, CA Anjan Babu. I also acknowledge the presence of our one more speaker for the day, Kaushik Raj here. Welcome to you, Anjan. Can we have a big round of applause? I request chairman to give the welcome address.
Good morning, everyone. Today we have gathered at Valuation Samvaad to explore and enhance our understanding on financial valuation. A foundational element of a profession, which is an opportunity for us to delve into the intricate aspects of valuation that influence at our work. Valuation is not just the numbers. It involves judgment, interpreting even the economic environments and understanding the forces that delve into various asset classes. Today's session will cover pivotal aspects such as purchase price allocation in M&A, equity value allocation among different shareholder classes, and impact of various statutes on valuation. These discussions are designed to refine our technical skill, ensure that they are in line with the global standards, and also that which is deeply rooted in Indian context. I encourage you to engage deeply, question thoroughly, and throughout today's program, let's consider it as an opportunity to gain knowledge and also to put these practical aspects insight into our professional and contribute to our economy. I thank you all of you for being here. I extend a hearty welcome to you all. Without taking much of the time, let's start today's proceedings. Thank you.
Thank you, Chairman. Before we inaugurate the session with the lighting of lamp, I would like to introduce the speaker of the day for this first technical session, CA Anjan Babu. He is a founder and partner at Inaugral. He holds DISA, EB, and of course FCA, a registered valuer too. His expertise lies in an in-depth knowledge of valuation practices, market dynamics, and penchant for meticulous research. He has over more than 10 years experience in the valuation, financial and regulatory domains, including a large CA firm services pan-India. A seasoned speaker, author, Anjan earlier used to deliver guest lectures at various forums, including ICA, BBA, that is, and colleges, various colleges. He believes success is the true story only when it results in net good for the financial advisory profession, society, and the nation. He has authored a chapter on Burke's method of early stage startup valuation, which was published by Springer Publications. Similarly, one more chapter on risk submission method, again on early stage startup valuation. He has also delivered address at the various statutory departments on ESOPs and other matters. It's a pleasure to introduce Anjan to all of you. Anjan, welcome to you. Thank you. We'll now we'll have the lighting of the lamp. I request Chairman and Anjan and also the speakers, Chinmay as well as Kaushik, to please come on dais, and also our MC member Dupat.
यैषस्सुप्तेषु जाग्रति यैषस्सुप्तेषु जाग्रति कामं 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 कापुरुषो पुरुषो निर्विमानः निर्विमानः तदेव शुक्रं ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः सर्वे तदूनात्यधिकश्च नान्यतीतश्च एतद्वैता 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 एतद्वैता
The first technical session for today is allocation of equity value across different class of shareholders. I request Anjan to take over the dais.
Raise of hands, I will give out two options. You let me know which is the correct option. Market value is a value that you compute in an Excel sheet. Option number 1. Market value is the value at which buyers and sellers are transacting out in the open world. Option B, how many? And option B, how many? Okay, great. So, option A, most of you did not choose. Obviously, market value is something that you do not do on an Excel sheet. Next, we will take up the concept of fair value. Now, market value everyone knows. What is the concept of fair value? I will give you two options. Again, listen to me very carefully. Option 1, the value at which buyers and sellers transact in the market on a theoretical basis. Or option 2, a historical transaction that has happened. Option A, how many? And option B. Option A. Okay. Option B. Okay. So, option A is the answer. Fair value is the value you do it theoretically. It is a theoretical computation of what could be. Ultimately, if you are an investor and if you feel something is undervalued, that's why I am putting. The price has gone down, that is why I am putting. You are actually, in theory, doing a fair value. You have a fair value understanding of something that should be higher. And you are thinking market has come down below that price. So you have kept a theoretical barrier and the price has gone below it. So that is theoretical value. Now the difference between a single person computing a theoretical value versus a fair value is, when you do a fair value computation, you should get into the shoes of both the buyer in the market as well as the seller in the market. And you need to consider every assumption that they must have thought of. Like whenever we go to any, let us say, Chickpet to buy sari, the shopkeeper already knows the bargaining techniques that the buyer will do. Similarly, some of the seasoned shoppers in Chickpet will also be knowing what are the techniques the shopkeepers are using to keep a high price, right? So you are an independent professional. When you do valuation, you are an independent professional who would have understood both the sides. And finally, what should be the final value which is workable for both is what you ultimately do when you do fair valuation. Alright? So that is in essence the understanding of fair value. Now I threw a little curveball at you. Okay? Little deviation. There is a terminology called fair market value. See, we understood market value. we understood fair value. Now there is another terminology which combines the both called fair market value. What do you understand by that? Because market is something that is happening out there in real world. Fair value is something that is happening theoretically in an Excel sheet. What is fair market value then?
Transaction between two independent buyers and sellers who are rational.
Yes. No, fair value is also that. You have to consider two independent buyers sellers who are rational, who are not coerced, where it is happening in an open market setting. That assumption you have to take. Then what is fair market value? Okay, I will let us understand this through an example. If you want to buy 10 grams of gold, like 10 gram of gold coin, you can buy it at the nearest jeweler shop. Now you have many e-commerce platforms that are delivering. In fact, Zepto was delivering for Akshaya Tritiya, correct? You can buy there. You can buy gold ETF, right? Nippon India has come up with gold ETF. Then Government of India comes up with sovereign gold bonds. Then you can go to European market and buy gold. Then you can go to Dubai and you can buy gold. Same gold coin. But do you think the price is the same across? Or do you find difference in price? Minute difference, small differences are always there, right? Why is it? Why will there be differences?
Physical gold, there will be obviously the extra cost of it.
Yes.
And of course digital.
Right. And it's also a reflection of those market conditions. In India, you may have to pay an additional GST to buy gold. Right? So, everywhere the market conditions there are so many things that drive a market condition. Like today, if you are in Israel, buying a gold might be much higher than what you might, because the market condition there is like that. The number of buyers may be much higher than the number of sellers. So market condition changes the value or the price at which the transaction can potentially happen. Do you agree with me? As simple as gold only, you cannot find the same price across various markets. So similarly, imagine when you are doing a theoretical fair value, you have to visualize the market in which you have to do this theoretical computation. So a fair value is a theoretical computation. When you bring in the forces of market in which you are dealing with, like whether India market or within India market, public listed entities versus private markets, market for primary transaction versus market for secondary transaction, the market conditions change, the participants change. So when you reflect that theoretical concept onto your fair value computation, it becomes fair market value. So now I think we are all on the same page on these 3 points, right? Market value, fair value and fair market value. Yeah. So this is what we discussed, standard of value. We understood what it is. Now to do this theoretical calculation of fair value, there are largely 3 approaches. One is income approach, then we have the market approach, then we have the asset-based approach. Let us just talk about income approach. So I told you fair value is just like a theoretical computation, correct? So now let us think of how we can do this theoretical computation. If there is an entity, now from gold we are going to little bit one layer up, which is a private limited company or a public limited company. Let us say you want to invest, you want to put your money in that company. There are various drivers for it. Invariably what will happen is many early stage investors, like when I say early stage investors new into the market. Investors new into the market, imagine a listed entity. They may look at only the historical performance. because that is one thing that is something that is there in everyone's hand as a fact. They may look at some annual reports, they may look at some analysis by some companies, and they will see, okay, profit has gone up this year. That is why the share price may go up, so let me invest. This is a very rudimentary way of investing, right? But even though, let us say, the performance of the company has gone up, it may so happen that an investor who got to know that the profit has gone up and invested at that point in time may not make as much profit. Reason being, the market would have already priced in that performance. So if there was a certain performance expectation that the company is going to go up by 20%, even though 20% is a very big performance, when the actual result of the performance comes out and it meets 20%, still the share price may not go up so much. And someone who is entering after looking that result may not get that higher output in their profit. It is for a very simple reason, someone who is going to make that huge upside in profit as an investor will be someone who could have predicted it before the results came out, much before the results came out, and taken a position on it. So how can someone predict a much better result or even predict a result to take a position in a company? That is the question, right? That is the science that everyone is after. It's almost like time travel. You go ahead in the future, understand how the company is performing, go back in time and take position on that company. I'm pretty sure many of us would have also fantasized about this fact. Looking at how companies like Asian Paints, they have performed over a period of 40-50 years, the kind of stupendous returns it has given. We would be blessed if we were ever to get hold of a time machine. If we get hold of a time machine, we know how to make money, definitely, right? Now the art is to try to predict it without having a time machine in place. So that is, your ability to predict comes from the point of judgment and experience, and that is the most important component when you are doing something called as an income approach. In income approach, you try to find the future cash flows from a company. You predict it using all the variables that you have in your hand today, and you try to bring it to present value, and that will give you a fair value. That is one theoretical fair value, and that the approach is quite popular. It is called as the discounted cash flow approach. Then we have the market approach. In the market approach, what you do is you try to do an apples to apples comparison. It's like, hey, my company is earning 30 crore in revenue. I am in a garment industry. So what is another garment industry of my same size? What is their valuation? So if their valuation is, let us say, 3x their turnover, then I apply a 3x multiple on my revenue. If my revenue is 30 crore, my valuation is 90 crore. This is a very straightforward way of doing the valuation. Then you have an asset-based approach, usually used only in two circumstances. One, if the company is an investment holding entity and does not have any operations of its own. That is, you are like a fund, you are an equity fund. Then for you, discounted cash flow doesn't work out because it depends on the performance of your investments. So in such cases, asset approach, everyone understands, it is net asset value. You take total of asset, reduce it by liability, what you get is your fair value. But the asset has to be fair valued individually, and liability also has to be fair valued individually. So that is a asset approach. Now why we are just quickly learning about this is the most basic denominator we should be knowing to actually take up what is going to come next. Next, I have one query for you guys. Let us say you have a startup of your own. You are maybe 2-year-old startup, and now you are trying to raise funds. You want to raise about $5 million. Your authorized share capital only has equity shares in it, and now investors are, you are going in the market to find investors, and you find some investors who can invest in you. Now the question comes, if you were to raise the full 5 million or 10 million, whatever you are looking for, which transaction structure will you take is the question. So right away the most rudimentary way of looking at it is, what instrument are you going to give it to them? You have largely 3-4 options. One is you can straight up give equity shares. If you give off equity shares, your shareholding in the company will come down. This is one straightforward way of looking at it. Next is you can give debt to them. You can take it as a debt and you can issue them some debentures. The problem with this is investor may not find it appealing. Then you have preference shares, which gives a little bit higher dividend than interest and so on and so forth. Apart from these three, if an investor is looking for higher return, but they are also you also do not want to reduce your shareholding pattern right away, is there any other option that we can do? Optionally convertible, debenture, preference share, any of that. Then there is this, why do we need to optionally give them? Why not give compulsorily also?
They want to exit.
If they want a cash option and that exit they want from the company only, then optionally convertible. If they are okay with if they know that the company cannot give an exit to them through a cash thing, they can do a compulsorily convertible also. But what actually determines whether to go for a preference, debenture, equity, it is all about managing risk and reward. So let us just understand what the promoter wants and what the investor wants, right? So first of all, the promoter wants a complete control over the operations of the company. Just because they took investments, they don't want someone coming and sitting with their day-to-day work. They want to do the work by themselves. That is the reason why they are in that field, first of all. They don't want someone else on the operations. Second is, startups have difficulty earning profits because their priorities are elsewhere. Their priority is on growth rather than making profit. But if ever the company breaks into a profit, the promoter would want a claim on that profit. They don't want to be excluded out of it. And because they are sacrificing everything, see, startup founders, especially of those which have reached a certain stage, are extremely competent and highly competent people. Their use, if not for the startup, for the world, can be potentially much higher. And they can also make extremely good living for themselves if they were not running this startup. So that means for the amount of talent, effort, hard work, everything that they are putting in, they want that equivalent proportional return on their investment, which is money and blood and toil, everything. And finally, in case the company has an M&A exit, or it has an IPO, or whatever, any of this form of exit happens, and any distribution of wealth happens to shareholders, whatever additional wealth they would have created, they would want a right on that wealth. So these are the requirements of a promoter, the most core one being the last point here, which is control and voting rights. They want to maintain control. That means they have to have a good amount of shareholding in the company for them to be motivated enough to continue to build the company. If their shareholding goes below a certain level, they may not be motivated to go on with the company, they might as well start a new venture. So now for an investor, what happens is each investor will have their own investment thesis. Like if you were to enter the stock market, you will have your own investment thesis. In the same way, if you are in private markets, you will have your investment thesis, because typically how a fund is structured, it requires the money to come back within a period of 8 to 10 years. So typically how it works is, let us say you start an angel fund, or you start a private equity or a venture capital fund. First of all, you can be a professional partner or a GP, basically a general partner. You are not the one putting the money, you are the one managing the money. You have to go and campaign to raise funds for your angel investment, that is for your fund. And these investors do not want to lock in their money for more than 10 years. They are saying, whatever you do, I want my money back within 10 years. That is a reasonable period of time. That's the general market practice. So these people who give money, they are called limited partners. Limited partners put money into the fund. Once the money comes in, it takes about 3 to 4 years to just deploy the fund, because the general partner has to listen to so many go to so many pitch meetings, listen to so many startups, build a conviction in their mind that it is an investable company, and invest the money. So when they do that, that would have only taken 3 to 4 years. So once the money is deployed, we have to return back within the next 5 years. So they want an exit within the next 5 years. Any private fund that has entered a startup as an investor, they would want an exit within a period of 4 or 5 years. And that exit has to work with their power law. So the power law, which is most famously known as only 2 in 10 startups will succeed, and those 2 startups will make up for all the money that the remaining 8 startups would have lost. So imagine all of this, and now what is happening is the power law is becoming a little bit more efficient in these companies, and what it is happening is 2 in 10 startups will make money, but about 3 to 4 startups out of 10 startups will at least give them back the minimum investment amount that they have made. They may not make great returns, maybe returns of 5%, 10%. So only when they do that, the whole thing is working out for startups. If all the 8 startups collapse, even the 2 startups will not be sufficient enough to recover back the money. So they want at least some 3, 4 startups to at least give back the investment and not completely burn it. And the remaining 3 startups can completely burn it. So this is the whole investment time horizon, success rate that the venture capitalists and angel funds are looking at. So that means when they are putting money in our company, the transaction has to be structured to meet that investment thesis. If it doesn't meet that investment thesis, it doesn't work out for them. So that means what they need, invariably all of them will require a preference in returns. Invariably everyone requires a preference, at least to the extent of the money invested by them. None of them are okay to completely burn down the money. If the power law was, okay, only 1 in 10 startups succeed or 2 in 10 startups succeed, and I am okay with the rest all going and burning, then they could have just as well invested in ordinary equity shares. But they are looking to maximize the return, and that is why there is a minimum guarantee of sorts, also known as a liquidation preference, that these investors are looking for in the companies. Exit participation is of high importance for them. If there is any exit in the form of an acquisition or another round of fund, another round investor like a Series C investor looking to buy out the seed stage Series A investors, they are looking to have a preference in that participation, or at least be in that participation. Valuation protection is one of the most important things that they are looking for. We would have come across this term called anti-dilution. So can anyone give me a quick briefer on what anti-dilution clause is? Okay, so let us say you invested in a company. The per share price of that company when you invested was about 600-700 rupees. Let us say 600 rupees. You invested in the month of April 2024. Now we are in the month of May. The promoter has gone ahead and raised money from another set of investors at just 400 rupees per share. You have got it at 600 and someone else has invested at 400. See, in a regular market, this we may have we have faced, right? Like, let us say we are going on a holiday and we book a hotel. Let us say you paid some 8,000 rupees for the hotel, but you also come across another guest in the hotel and you are chilling by the pool and the topic comes how much you paid. They may say I paid only 5,000. Then even though you could have afforded the 8,000, the whole holiday will have a little bitterness attached to it. So similarly, there will be a bitterness with this investor who would have come in. So that is why the investor always insists on this clause called as an anti-dilution. That means if there is a future funding round that happens not just within 1 month, not just within a year, but any time in the future, as long as they are an investor in the company, if a funding round happens below the price at which they have invested, to the extent of extra money this investor would have given, they need those additional shares. That means in our example, for another 200 rupees more, that is the difference between 600 and 400, another 200 rupees more, the company must allocate fresh shares to this investor. So this is called as an anti-dilution clause, also famously referred to as down round protection. So this valuation protection is something that the investor wants. Of course, this requirement is not there with the promoter. Promoter is just in it for the gain. And next is liquidation preference. Whenever there is money at the time of acquisition, let us say you get a whole chunk of money, but that money is not sufficient enough to pay off all the investors. Like when you apply that waterfall model, no? First you need to pay off all dues to employees, then government dues, and then assets with specific debt with specific charge or assets, then unsecured debt. So like that there is a waterfall, right? In this waterfall when we do, the investor does not want to be lost among all the ordinary equity shareholders and just fight for scraps. They don't want to fight with all the common equity shareholders for scrap amounts. They want assurance over their liquidity, or the money that they have invested, and that is called as a liquidation preference. So this is a liquidation preference. So while we are talking about liquidation preference, I have one very interesting situation to share with you on how liquidation preference can go against the interest of employees. So there was this one company called Good Technology Limited. This Good Technology Limited was started by ex-Motorola employees, something to do with mobile technology. Now what happened is, there was this huge class of investors that had this liquidation preference. They had CCPS, compulsorily convertible preference shares. When I say CCPS, it means compulsorily convertible preference shares. So they had this CCPS. The CCPS was about 500 million. That is 500 million investment that had happened. And on another side, the employees of Good Technology were given ESOPs in the company, and they had foregone their salaries in favor of ESOP. That means if someone was worth 70 lakhs in the market, they were receiving, let us say, just 20 lakhs, and 50 lakh they had taken in ESOPs, thinking that the company will do really well. Now this liquidation preference investors were there. No? They had not just liquidation preference, they had something called as a participating right. That means once the minimum investment amount is repaid back to them, they also have the right to participate along with ordinary equity shareholders. So it may so happen when good technology was acquired by our age-old mobile phone company called BlackBerry. Good technology was acquired by them. The acquisition just happened at $600 million. Liquidity preference was $500 million. So immediately $500 million went off to investors. And remaining $100 million was there. No? There also again investors participated and took away some $50 million from it. And only remaining $50 million were there. The ESOP holders that were there, no? In US you have to pay tax as soon as ESOP is allocated. In India it is when it is exercised. There in US it is as soon as ESOPs are allocated you need to pay a tax. So these employees had paid a tax at a much higher valuation. Now there is only $50 million left. That has to be between the founder and employees, and it so happened that they could not even recover the tax amount that they had deposited to the government. Income tax amount also they could not recover. So much of loss they made by taking ESOPs. So this is how dangerous the liquidity preference can be to the rest of the stakeholders in the company. So now these convertible instruments are typically a combination of equity, debt and an option, that is a call option. Call option is a contract or an option to buy shares in the future. So we understood what are the requirements of an investor. We will see why these convertible instruments are given. So one is a component of debt gives you liquidation preference. That is your security of principal is assured if you have a debt instrument. Because in equity, whatever you invest can be completely burned and you cannot get anything. But at least debt you have some preference in repayment. The thing with debt is, it does not have higher return. Its return is limited to whatever interest rate you might have agreed upon. So, a component of equity will give you higher return. And an optionality will help you to convert your debt into equity. So, this is how it is structured. Now, the thing is that option is with you, so you have a control on your payback period. That means if you are payback, you want the money back within 5 years, you can exercise the option, convert into equity and exit. Or if, as sir had told, if you had an optionally convertible, you can exercise your option to get your money redeemed back. So, a component of option gives you control to switch between equity and debt as and when you require. So this is a typical payoff chart if you are a convertible instrument holder. See, how you can observe in a debt the return is stagnated. Let us say you have invested 1 crore or 100 lakhs. So if the debt, if the company value, let us say the company has a valuation, company value comes to 100 lakhs, you have invested 100 lakhs. So you will get your minimum amount because you have that preference over that 100 lakh. But if the company value dips down 100 lakh, let us say it goes to 80, 70, 60, you will not recover back your minimum amount, but you will be given the first preference in payout. Now, if you have an option and let us say you want to, it works out for you if you convert when the company is about 350 lakhs in its valuation. So from if the company hits 350 lakhs, then you only have an upside from here. That is, the company can continue to grow and you can have a continuous upside. So one is an option, one is a debt. If you combine them, the payoff chart will now change. That is, up until 350 lakh you have protection. and from 350 lakh you can enjoy the returns. So this is the beauty of a convertible instrument. Your losses can be minimized while you can still be in it for the upside. So all these investor and promoter interests can be bucketed mainly into two areas. One is the interest can be of a control right, that means the interest to gain more control over the company, or it can be an economic right, that is I want to make my return on investments. These are typically what goes into a shareholders agreement. All of these rights are discussed. So voting rights, of course, we all know. Veto rights, I think that's also self-explanatory. That is, if you have a share, a certain class of shares, and you don't want certain decisions to go your way, you can have a veto right built in where what you have to say is the last line, and the company has to go by it. That is a veto right. Board composition right to appoint a board. Now the question is on drag along rights and tag along rights. So can you give me, any of you know what a drag along right is?
So if you want to exit, you will drag you along with them.
You want an exit along with the
Yeah.
rest of the, and tag along?
When you want to exit, you can tag down the promoter.
Yes, correct. So drag along right is, let us say you have found a very profitable exit that you can make for the company as an investor. But the buyer wants the whole company to be acquired or a certain number of shares to be acquired, which you don't have. You may have only a fraction of the shares. So you can make the rest of the shareholders drag along with you for the exit. So that is a drag along right. Let us just wait for a moment. So that's a drag along right. That is, in a drag along right, you will make everyone else party to the transaction whether they want to be or not. That you can build it into a shareholders agreement. A tag along right is the inverse of it. That is, if certain shareholders are exiting, you can be mandatorily become party to it. Like if you want it to be, even though the buyer does not want your shares. You can tell, no, there is a tag along right, and you can be party to the shares. And other investors may have to compromise in the number of shares that they are selling to the investor by accommodating your shares in the transaction. So that is a tag along right. Then right of first refusal, I think this is a very common theme built into invariably in all articles of association in private companies, right? That is, if you are going to sell the shares in the market, if you are an existing shareholder, you will need to first offer these shares to existing shareholders. Only upon their refusal, you can sell it in the outside market. So that right of first refusal is common in India, but it has picked up pace and popularity because it was not a common thing in the West. So there everyone is very specific on getting this right of first refusal right. But in India, invariably it comes up in articles of association if you have adopted without any modification. Then founder share vesting is if the founder is having lot of shares or they want more control in the company, but the investors are wary that their own shareholding will come down. They can tell the founder, they can create a win-win deal. They can say, promoter, I know you are quite motivated to grow the company, but I cannot and you are inexperienced, you have not done any startup earlier. How can I trust you just blindly? What you do is we will link your shares to the performance that you will be doing. So the better the performance of the promoter, more the number of shares that the founder will get vested in his name. So that is founder share vesting. So then economic rights, largely economic rights are claimed by investors, not by promoters. So in economic rights you have cumulative preference dividend, that is if company has not made profit for many years, the preference dividend can continue to accumulate and pay it later. Liquidation preference we have discussed. Now in liquidation preference, there is one carom ball. Let us say there are 4 different classes of investors. Series B, Series C, Series B, Series A, like that. 4 series of investors are there. Let us say each investor has invested 100 crore in the company. From Series D till Series A, everyone has got 100 crore. 400 crore is the investment done. Now the company has secured an acquisition at 350 crore. It did not go as planned, so the acquisition value is lesser than what the investment value was initially. So 400 crore is the liquidation preference, 350 crore is what is recovered from the acquisition. Now how will you distribute this 350 crore amongst these 4 classes of shares? So there are 2 ways it can go. Both ways are used in the market, but pari passu is generally given preference, or it is little popular. So the first way is, you can say that the most recent investor must be first given off his exit, because poor fellow, he came just now, immediately the acquisition happened and that went bad, right? So at least don't bother him too much. You give off his 100 crore and remaining 250 crore, the remaining 3 people we will take. That is one. Then another argument is there. Series A fellow will tell, boss, I have been suffering from the past 4 years. I should be getting the 100 crore first. And the later stage investor, they should have known, they should have taken better judgment. For me, lot of variables were there when I invested. I couldn't have predicted such a poor exit. But because I took more risk, at least for me, you give the liquidation preference. Right? That is another argument. So another argument is, let us not even get into the dispute. 350 crore, we will take it off equally. So these are the 3 options. One is the later route can rank higher, earlier round can rank higher, and the most popular one that avoids all dispute is, people will be unhappy, happy everywhere, but at least it's a averaged out happiness in pari passu sharing. Averaged out sadness rather than happiness.
They'll be equally unhappy.
Equally unhappy. So now we will be looking at a situation not when 350 crore is the valuation for 400 crore investment, but much happier times and situation where if you have invested 400 crore and the valuation is 800 crore, how will you distribute the winnings is the exercise that we will try to get. Because anything below that, it almost becomes a contractual matter, but anything above that becomes a matter of financial calculation. So we discussed 2 different rights, right? One is the control right, the other one is economic right. And I also generally told you in the back there, economic right is generally the investors would like to have those economic rights built into the shareholders agreement. While control rights, the promoter would want to have control rights. Whatever control right clauses we saw, the promoter would prefer to have that, while economic right, this investors. So that means we need to be very clear on what we are doing when we are doing valuation. So as I told you, theoretically, let us say we have a valuation of about 800 crore. How are we distributing? First, economic right has its own value attribution, and if you have control right, that also has its own value attribution. So, if 400 crore is your investment, 400 crore is liquidity, exit that you got, it's very simple, share 100 crore with everyone. Downside also driven by contract. Upside, we have to drive it by option pricing model or any of these 4 methods that I have told. Option pricing model, you have current value method, probability weighted expected return, and Monte Carlo simulation. Most popular one is the option pricing model because it gives a very fair and straightforward way of allocating. current value method and probability weighted expected return has some subjectivity involved in them. So that is why unless it is some negotiated number and you need to create an explanation for that, you don't go with these two methods. Monte Carlo simulation is the best method, but it involves too much of computational exercise to be done. So most popularly, option pricing model is used. The difference between Monte Carlo and option pricing is, if option pricing gives you 95% accuracy, Monte Carlo gives 99% accuracy. That is the difference between them. So that 4% is not sufficient enough payoff for people to invest too much effort into building a Monte Carlo model. So that's why option pricing is generally used. So now control and liquidity, all remaining control rates are driven by premiums and discounts. So I will give you one typical example. Let us say there are two classes of shares. One is an OCRPS, that is optionally convertible or redeemable preferential, and another one is a equity share. Now OCRPS does not have any voting right, but equity share has differential voting rights. That is, if voting right for an ordinary share is one share, one vote, this particular share has one share, 10 votes. So if someone is out there in the market looking to control the company, they wouldn't go for an OCRPS because first of all it has no voting right, and even if time comes for conversion, you get just one share, one vote. But here you have in the market a differential voting right equity share where you have one share, 10 votes. So someone looking to control the company, which one would they prefer? Differential or OCRPS? Differential. So would I err in saying that it is easier to sell this differential voting right in the market rather than this OCRPS? It's easier to sell, right? It's easier to sell this in the market. Because it is easier to sell, your waiting period comes down. Let us say you want to sell it in the market. You have to find a buyer. Your waiting period for a regular equity share or an OCRPS may be 7 months to a year. But this may get sold off in 3 months. That means your cost of holding the share comes down. That means the illiquidity discount, that is the discount that you apply for one share being more illiquid than the other, it comes down. So for a regular equity share, you may sell it at a discount of 20-30% of the fair value in the market. But this share you may just sell it at 10% discount in the market because you have better negotiating capability, more buyers are there. So all control rights are measured like that. They are measured through discounts and premiums. Discount on fair value or premium on fair value if you are getting more control. I have another interesting question. Let us take the example of any company like, let us say, Infosys. Infosys may have a free float market cap of about 30% of their company. Then there is a remaining 70% controlling stake in the company. For the 30% that is out there in the market, when you switch on the TV or go to money control, you can see the share ticker price. The remaining 70% also, will it be valued at the same price as this 30% that is you can see in the ticker? Okay, I have 3 options. Valued the same, you can raise your hand. If you are holding the 70% stake in the company, the same price which is there in moneycontrol.com, it's the same price for that remaining 70% also. Anyone? Okay, it is below that price. Okay, below that price, any reasoning?
Because you want control, you want to sell the price.
No one wants the control.
No. Because the 70% people want control.
Yes.
So there's a little discount for them. They don't want to sell the stock.
Correct.
So they only want to acquire the stock, more stocks. So they won't want to sell the stock, so the price is always less in the market.
It will always be lower.
Yeah.
Okay. But if someone doesn't want to sell something, isn't it more valuable?
For himself, yes. Not in the market.
No, aren't there many people who want to take control of Infosys? Like let us say TCS, or let us say Wipro, or let us say any software consulting giant in the world. Don't they want to take control of
It
Infosys?
depends on.
Yes.
So you are selling something. So why do you want to sell? Is it going to go down the drain? Not Infosys.
Yeah.
It's also a company. You are the promoter. You want to sell.
Yeah.
You don't have confidence in your own company. Then the value which is asked by the market may be less.
But the other shares will also go down. If promoter himself doesn't have confidence in the company, they are selling it. The remaining shares will also go down. Don't you think?
Yes.
Yes, yeah.
If the promoter jumps the ship, the remaining investors will not run the ship. They will also jump the ship. Okay. So actually something where the buyer has more control and you get an additional right, like common equity share, that is free float market. When you buy the share, that is all what you get. It will be parked in your demat account and nothing else is of utility apart from dividend payout and capital gain. But if you were to take a controlling stake in the company, not only do you get a share in your demat account, you can start one at a time throwing your weight around. Maybe you can ask for the director to be changed. Maybe you can ask a certain policy to be changed of the company. So you get that weight to throw around on the board of the company. And that is the power people are out there trying to get. So that is why the controlling stake is given a higher valuation rather than the minority stake. And further, minority is always subject to the egos and the decisions of the majority. They are bound by it. So even if you as a minority shareholder have a different point of view, it is only for democratic purpose. They will take their point of view, record it in the general meeting minutes, but it has no tangible value apart from it. Whatever the majority decides, finally that is the value that it takes and the shape it takes. So controlling rights this is how that assessment happens. Whether it should be given a premium or a discount, this is how it happens. So statutory acceptance of this allocation methods that I told you about. One is you have this Companies Act and IBC. There it is driven by something called as valuation standards, which Kaushik will take in the third or fourth session. Yeah, valuation standards. It is given by ICA, valuation standards, and Companies Act and IBC takes home in valuation standards. Anything related to valuation, you can refer it over there. The Income Tax Act of 1961, up until now, the famous angel tax or the 56(2)(7)(b, up until the month of October, there was no creative allocation method that you could do. That means a Series D equity shareholder, CCPS holder or whatever, has to be valued the same way per share basis on an entry level investor as well as an ordinary equity share. So you could not differentiate the pricing between the different classes of shares, even though they have different rights attached to them. But now in the October notification, option pricing models can be used to do the valuation. FEMA, again no clarity, it just tells internationally accepted pricing methodology, depends on banker to banker, intermediary to intermediary. If they are friendly with you, they will not look at the report much, they will pass it. If not, if they want to give you trouble, they will give you trouble. So now we look at the concept of a liquidation preference deeply with a scenario based example. So try to note down these facts. It will be easy to follow through the complete scenario if you note down these facts. So there are 4 classes of shareholders. One is an ordinary equity shareholder with about 1 lakh shares they hold. Then there is a Series A CCPS with about 20,000 shares, Series B 10,000, Series C another 10,000. The liquidity preference per share, of course ordinary equity shareholders do not get any liquidity preference, but the Series A fellow has 35,000 rupees per share as a liquidity preference. If we assume that is the price per share at which Series A person had invested, then you can assume that 70 crore is the investment value by Series A CCPS. Series B CCPS has a lift pref of 80,000 and investment of 80 crore. Series C CCPS has a lift pref of 1 lakh rupees per share and total lift pref of 100 crore. So just as a like a quick understander, like if you have invested at 35,000 rupees per share, you need to get that minimum amount back. That is the concept of lift pref. All classes of CCPS rank pari passu. Liquidity preference values are the prices at which investments were made as well. Okay. So this is not that situation of some class of CCPS ranking higher or lower. It is a pari passu ranking. Okay. All right. So now let us study the journey of a Series C CCPS holder. Like they have invested at 1 lakh rupees per share and they have invested a total of 100 crore. Let us understand how their journey in the company will go. So that graph helps you to understand. As you can see, if the Series C CCPS had to be invested, has to get about 10,000 shares and they have invested 100 crore in the company. There are a total of 1,40,000 shares, correct? There is a total of 1,40,000 shares. So if they have gotten 10,000 shares for 100 crore rupees, that means at the time of investment, in this company, the company valuation was 1,400 crore. This is through reverse mathematics, right? We are all on the same page. 1,40,000 shares, 10,000 shares value is 100 crore. So what is the value of 1,40,000 shares? It is 1,400 crore. So now for the CCPS holder, I don't know whether you can see the graph, the numbers. 1,400 crore is in the end, where the dotted line has come. The last dotted line is there, no? That is linked to 1,400 crore. So anything below 1,400 crore up to 250 crore, it is an investment protection zone. That means if the company starts falling as soon as the investment happened, the knife can keep on falling, but hopefully it stops at 250 crore. Because at 250 crore, that Series C person can still recover back their money. How is it possible? Because all of them rank pari passu. 70 plus 80 plus 100 is 250. So up until the point in time the exit value is 250, all of these shareholders will get their minimum pref value. But below that it is just a fall zone. Hopefully it stops falling at some point in time. But anything above 1,400 crore is a zone of profitability. So imagine the amount of right that they have. The company is now valued at 1,400 crore. It can fall up to 250 crore and still there is no loss. I mean, theoretically they can still recover back their minimum investment value. And anything above 1,400 crore is a profit. So that's a beautiful way of structuring your transaction where your downside is very much limited and you don't incur too much loss. Now let us say you are a Series C CCPS holder. At every point in time, whenever there is a proposal for an acquisition of the company, you have to take a commercial decision. So the commercial decision is like this. If you continue to be a CCPS holder, you will get your liquidity preference, the minimum amount. But if you decide to convert, you no longer have any special rights. You become a commoner. You become one among the equity shareholders. So for you to take a decision of what matters is your payoff when you convert into an equity shareholder. Will it be higher than the value at which you had invested? So I have taken a very simple example because of the time that we have. See, we are already at 11 and I think I have to wrap up pretty quickly. This can get very complicated. Imagine a scenario where there are 10 different classes of shareholders. Along that, add to that the complexity of ESOPs, then complexity of share warrants. Imagine what happens. You don't even know how many common equity shareholders are there. So how will you take a decision to convert into equity shares becomes quite complicated. So the next one is for Series B CCPS. Their investment value was 80 crore. So that means when the valuation was 1140 crore, that is when they had entered. For them to get 80 crore, that time there was only 1,30,000 shares. So 80 crore for 10,000 shares and 1,30,000 interpolating, the valuation is 1,140 crore. So below 1,140 crore is a down zone for them. I mean, liquid protection zone for them. Below 250 crore is a down zone. Above 1,140 crore is a huge payoff. So similarly for Series A person, 70 crore was their investment. Valuation was 600 crore. For 70 crore they got 20,000 shares. So valuation would have been 60 crore, 600 crore. So similar logic follows. Now let us look at the journey of ordinary equity shareholders. Up until the company reaches 250 crore in valuation, there is no payout only for ordinary equity shareholders. From 250 crore onwards, some payout will start because 250 crore will be gobbled up by the liquidity preference investors. They will not have anything left in their hand. So what we took up those points, that is 250 crore, 600 crore, 1140 crore and 1400 crore. These are all the various break-off points where the inflection point, that is the decision making point to convert into a equity shareholder or not, comes into picture. And this is how the allocation will go if these were the break-off points. Like for example, if 250 crore was the valuation, all of these classes will get their minimum liquidity preference amounts, that is 100, 80 and 70. But if 600 crore was it, they will get their minimum liquidity preference. But can you tell me who is at an inflection point at 600 crore where they can decide to convert into equity or not? Series A. Yes, Series A beyond 600 crore can decide to convert into equity share. And ordinary equity shareholders get a payoff of 350 crore at a valuation of 600 crore. And 1140 crore is the valuation. For Class B, it is an inflection point, and 1400 crore, Class C is an inflection point. 2100 crore I have just taken as an example where for nobody it is a dilemma whether to convert or not. Easily they can convert. They have no limitation on it. If they convert, they will get very good payoff at 2100. I will quickly continue the scenario just to take you through how this valuation is exactly done. Let us assume the company valuation is 1700 crore. 1400 crore was the final break-off point, but the real value of the company is 1700 crore. So first we need to see how the break-off works and where they get payoff. Up until 1400 crore, we can see that ordinary equity shares for a valuation of 600 crore get the first additional payoff of 350 crore. They don't, they will start earning money from 0, they went to 350. And at 1140 crore, along with ordinary equity shareholders, Series A person will start enjoying the benefit. They will get an additional payoff. And then finally at 1400 crore, other than Series C CCPS, rest all other shareholders, they are getting an additional payoff beyond what they had invested. That is when, let us say, the Series B fellow would have converted, and Series C fellow will be thinking whether to convert or not. That is the final inflection point. So applying an option pricing model and also checking in each inflection point in the payoff, additional payoff that is there, who is taking the additional benefit. That payoff benefit is explained in the second table, and in the first table the option pricing is explained. I am not going to go into it because we don't have sufficient time. Finally, this is how the 1700 crore will be allocated against different classes of shareholders. Basically, the option price is multiplied by the ownership in the payoff in each inflection point to arrive at what is the final ownership over that 1700 crore value. As you can see, the Series B and Series C are taking the same amount of valuation because both of them hold 10,000 shares each. Series A person is taking twice the amount almost because he is holding twice the amount of shares than Series C and D. And ordinary equity shareholder is the biggest winner in all of this. So this is the total way in which allocation of equity will happen. We have not even scratched the surface of how deep this topic goes. It can go into multiple layers. What will happen if there is a partly paid equity share? That can get quite confusing. I have another question, I have another googly for this. Let us say Series C CCPS does not have a conversion ratio only fixed. So when they convert from preference share to equity share, let us say that 1:1, 1:2, nothing is fixed. What do we do then?
It is possible, sir.
Yeah, you can issue CCPS without a conversion ratio. With conversion ratio being determined at the time of conversion. That can be done. Another googly, let us say you are a Series A CCPS holder, but you do not agree with the valuation with the company because the company is, let us say, too early stage for you to determine the valuation. So they will say, I will just invest in you. You take the money in a convertible instrument like a safe note or a CCPS, CCD, OCPS, any of that. But when the next funding round happens, whatever valuation gets established there, give me a 15-20% discount on that. And whatever discount comes based on that value, I will convert or take an allocation of the equity shares. That is also possible. So how do we build that into this model? What happens if there is share warrants, ESOPs, or founder vesting shares are there? Things can get extremely complicated in this setting. So this is just, we have just given an intro into how it works, but it can have a much deeper, it's like a glacier. We only saw the top part of it, the bottom part is still there for us to understand and explore. Since this was more of a primer kind of a session, we didn't go much deep into it. If you have any discussion points or questions, we can take it up.
Sir, the calculation which was made is option pricing.
Yes, I have done a Black-Scholes option pricing. The first table is there. No? That is a Black-Scholes model. So the implied equity value that you see in the first line is the spot price. So in Black-Scholes there are 5 variables you need to take. The spot price, the strike price, the periodicity, volatility or the standard deviation, and the risk-free rate. So the spot price is that implied equity value. Strike price is the different inflection points that we saw. That is 250 crore, 600 crore, 1140 crore and 1400 crore. Time to expiry is 4 years. This is basically at what point in time the company founders are expecting an acquisition to happen or the company to go into IPO or an exit for the shareholders can happen. That is the time to expiry. Risk-free rate is for the 4-year period, whatever is the risk-free that is in the market. I have taken a Government of India bond rate which is about 7.13%. Volatility is the standard deviation, that is how volatile the industry is. That I have assumed at 40%. You can get databases of it or you can compute it yourself by taking comparable companies. options. And then I have done a fair value of the options by using a Black-Scholes model.
Volatility is basically volatility in the share price of the company.
Yes. So, for example, if you are an Infosys, you can compute your own volatility using the share prices. But if you are a privately held company, you can take a comparable company or industry volatility.
Generally, when this acquisition happens, this was your use.
Not when acquisition happens. There are many uses. See, whenever fair value happens, this should be invariably be done. Whenever you do fair valuation, let us say your client company wants to raise funds. That time you have to invariably do to arrive at fair value of the class of shares that are being issued. Apart from that, let us say you are a fund. You are holding class A shares. You want to reevaluate for your financial reporting purpose or to give to your investors. You want to tell what is the value of the portfolio. Let us say some recent fundraise has happened at some 80,000 rupees per share. But that is Series B CCPS. You may not be able to adopt the same price for your holding. You will have to come and arrive at your value holding, and for that you apply this model also.
How do you celebrate that has come up in the implied equity value? Is the enterprise value in your example, or is this the per share value?
1700 crore is the total equity. Yes, equity value, not enterprise value. Enterprise value would mean it includes debt in it. It's the this is equity value. Thank you.
Thank you, Anjan, for that hilarious start for this session. And there are two following sessions that will happen: purchase price allocation in M&A and the valuation triggers across various. May I call upon Chairman to please hand over token memento to the speaker, Anjan Babu. Thank you, Chairman. Thank you, Anjan Babu. And we will just break for a quick refresher, Betty, and reassemble at 11:30 sharp. Okay? Thank you.